Ladies and gentlemen, and we're back. We're going to have a conversation now with two investment advisors about their world and how it interacts with the economy. To my immediate left is Bill Kennedy, who is with Field Point, based in the United States, but he started his career here working on Japanese equities in Tokyo, and then subsequently worked for Salomon and Citigroup. And at the end of the table, Alex Ortiz, who is with Afina Financial, which is a group that's near and dear to GIC's heart, as the three principals, Ben Leavenworth, who's here in the room, David Godfrey and Alex met at a GIC event in Santiago, Chile, and started their business there. So we're proud parents and happy to have them here with us. So I'm going to let Bill go first, and then Alex, and they'll both present from the podium with pretty slides, and then we'll have questions which we'll handle here from the table. Thank you.
Good morning. I'm very pleased to be participating in the GIC Central Banking Series here in Singapore. Of course, when we say GIC, we mean the Philadelphia version, not the Singapore version. And I'm very honored to share the stage with Michael Drury and Alex Ortiz. My subject is to talk about the investment landscape from a U.S. perspective. We look at global investing through the lens of asset correlations. And what we've noticed really since July of last year is a profound and dramatic shift in correlations across asset classes and within asset classes. Three reasons behind this and three major drivers. The first is we have seen global economic activity improving. The second, we believe, is a result of policy pivots by central banks. And the third is deglobalization. I'm going to spend time touching on each of those three issues briefly. Then I'll lay out what we see as the key investment risk over the coming 5 years. And then I want to talk a little bit about asset allocation and portfolio design and how those are being influenced by the market that we see today. So the good news is that economic activity is improving. We see it in the data, and you can certainly see it from what the market is telling you. Interest rates are higher. Stock and commodity prices are higher, and we have seen credit spreads tighten dramatically over the last 6 to 7 months. If you look at this data, this is a chart from Citigroup that shows the Citigroup Economic Surprise Index. It's a very simple diffusion index. When the number is positive, it implies that economic data is better than expected, and vice versa. And what you can see over the last year is a continuous and consistent trend of data improving. And now, both in developed and developing markets, we see that economic data is better than expected, with a reading of about 40 on this index. And that's the highest reading we've seen since 2010. Leading economic data is improving as well. This chart I borrowed from Don Rissmiller at Strategas. Thank you, Don. But this shows the leading economic indicators on a global basis have gone from negative to positive. And this bodes well for real GDP growth over the coming quarters. So as the market has shifted its expectation from stagnant global growth to accelerating global growth, we think this has been a cause of some of the shift in asset correlations. The second factor has to do with policy pivots by central banks. Specifically, in September of last year, we were surprised when the Bank of Japan removed its negative interest rate policy and instead announced a policy to target 0% interest rate at the 10-year part of the JGB curve. So the BOJ went from NIRP to simply ZIRP. The second policy pivot that we think the markets responded to was a speech given in October by Janet Yellen at the Boston Fed, where she articulated that the FOMC may be willing to allow the economy and inflation to run hot. Rightly or wrongly, we think the market's picked up on those signals as being an acceleration in inflation and inflation expectations. So when you look at break-even yields, we've seen break-even yields rise consistently since September and October of last year. We also see inflation expectations rising when we look at the forward inflation curves, such as the five-year forwards. But we've seen it also in the print. And in fact, recently, with headline CPI in the U.S. coming out at 2.5%, we think this notion of going from disinflationary or benign inflation to reflation has been priced into the market and through asset correlations. The third factor is deglobalization. We have seen populism spreading globally, whether it's through Brexit or the U.S. election or what's happening in France presently or what's spreading around Europe. We are starting to see an environment where it's throw the bums out. We're seeing the public grow very tired of the current ruling parties and very much willing to allow some pretty interesting candidates and some pretty interesting party leaders to come into power. So why is populism growing? It's a very complex question with some fairly complex answers and would probably take an entire conference. I know we're going to hear a little bit about populism later on, but my simplistic view is that populism in the U.S. is a function of the fact that for nearly a decade, the voting public has not seen much of a pay raise. In this particular chart, what we're looking at is real disposable income per capita in the U.S. And what you can see is that for nearly 13 years, it's been in a downward trajectory. So we think part of what is driving populist movement, whether it's in the U.S. or in the U.K. or France or other countries where they have a very similar chart to this one, is that fatigue is setting in amongst the public. So those three factors combined, whether it be through populism, and what we've seen with growth and expectation for accelerating inflation, we think have really been driving the correlation shifts. But nowhere has the shift over the last 6 months been more evident than in the bond market. Globally, we have seen nominal yields for 10-year bonds and 10-year JGBs go from negative to positive. In the U.S., we experienced a 125 basis point shock in the 10-year yield between July of the low and the peak, which happened in the middle of December. So what's driving the bond yields higher? Is it because growth is faster or inflation is more? Or is it something else? So what we did was to go in and analyze and decompose the 125 basis point move by the three component parts of a nominal yield. There's the real yield, the inflation premium, and the term premium. And what we found in our answer was that, indeed, both inflation and real economic activity were being priced in to higher bond yields. But about 70% of the move in nominal interest rates in the U.S. have been associated with a rising term premium. And this data is consistent with the data taken from the New York Federal Reserve Bank. So Citigroup's rates team will tell you that the term premium is as much structural as a cyclical move. And why would the term premium move? They would argue that foreign buying of treasuries pushes the premium down, and foreign selling of the treasuries will cause the term premium to rise. By extension, you could argue that any selling of treasuries would cause the term premium to rise. And what we've seen, particularly since November, is a very, very large short position in U.S. Treasuries. In fact, the speculative net short positions are at a historical high. And we think that has been part of the driver and part of the cause for the term premium in the U.S. To go higher. Like every good crowded trade, and I would argue that shorting U.S. Treasuries is the most crowded trade in the world today, it will unwind. And when it does so, that is buying of Treasuries to unwind those short positions. We think that will keep a cap on the term premium and, in fact, help to keep nominal interest rates relatively low. So let me turn now to what we see as the major risk, really on a 5-year view for the markets going forward. And to understand or appreciate anyone's perspective of investment risk, it's important to understand one's perspective. One of the things that I would suggest is, looking at this map, as a young boy in grammar school growing up in the state of Iowa, this is the type of map that I was learned taught to generate my worldview. Global map, right in the center of the map, in the center of the universe is the United States. Now, over my 28 years, it's been a shifting worldview, in part because of my time that I spent investing and working and living in this part of the world. But today, I think the map that would best express what I view as a major risk for the investment community is this one. This is a map that was produced by the World Economic Forum, and what it shows is the sovereign debt to GDP of all the major countries around the world. Those countries that have debt to GDP greater than 100% are reflected in red. Those that are between 60 and 100% are in orange, and so on and so forth. The larger the country on the map, the higher the debt as a percentage of GDP, or sorry, as a percentage of capita. So the debt per capita for Japan ranks the highest, followed by Singapore, Belgium, France, and you can see Germany, the UK, and the US surrounding. We view that global debt and the global debt overhang is the single largest investment risk facing the world today. The International Institute of Finance calculates that debt is roughly 350% of GDP on a global basis. There tend to be 5 ways to work your way out of a debt crisis. You can grow your way out, you can use austerity, you can devalue your currency, you can inflate yourself, or you can default. There's no possible way that the world will be able to grow its way out of a debt crisis, a debt bubble of this magnitude. Second, we have just come off of a 10-year experiment of fiscal austerity, which has generally failed. So as a result, either through currency devaluation, through inflation, or through default, these are the 3 primary ways to address the debt situation going forward. Excess debt and dealing with excess debt is a struggle. It hurts the future growth and aspirations and dreams of the citizens. And if we see any of those 3 options applied, whether it's through devaluation or through inflation or default, that is going to continue to put cracks in the social contract between citizens and their countries. And this leads us to what we view as the second most significant investment risk, and that's geopolitical uncertainty. The G7 historically has been a very stable, safe place to invest. Today, the G7 faces demographic concerns, it faces over-indebtedness, it faces underfunded pension funds. And as a result, for the first time in my career, I actually think that the geopolitical risk of the developed world is as high or even higher than some developing nations. Let me speak a little bit about the U.S., because to say that the U.S. election and the U.S. political environment is having an impact on investing would be an understatement. We are entering a period of Keynesian-based deficit finance fiscal spending by an all-Republican U.S. government. The irony of that fact is not lost on me. We're moving from what has been a decade of fiscal austerity to what we consider to be fiscal activism. The invisible hand of monetary policy, we believe, is going to be replaced with a very heavy hand of Trumponomics. And as that occurs, we think that this is going to raise a large amount of uncertainty in terms of how policies will be implemented both at home and with our partners in other countries around the world. So this leads me to the third risk that I see, and that's the normalization of monetary policy, whatever that means. And just to be clear, we're far less concerned about the 6 major central banks shrinking their balance sheet. We think that will occur over time. What we're more concerned with is the adjustment to the cost of capital, or the risk-free rate, or the discount rate that's used to value corporate finance projects or value any asset around the world. So this chart is from PIMCO, and what it shows is that the basic valuation methodology starts with a core discount rate or risk-free rate. And upon that risk-free rate, you'll add an inflation premium, a term premium, a credit premium, and an equity premium. When the core building block, when the risk-free rate is held artificially low, it leads to artificially high prices and artificially high valuations. Now, I know we have some MBA students in the room, so I just want to ask the question, and be very careful how you answer this because it will determine if you graduate or not. If you see the risk-free rate or the discount rate rise, what happens to your asset value? Anybody? Decreases, correct. So we think the major concern really is as we start to see the risk-free rate and the discount rate normalize over time, whether that's through the trajectory that the Fed or other central banks are putting forth, our concern is that the growth and drivers of the cash flows that are going to get discounted back will not be enough to offset the negative impact on valuations from the rising rate. And this is very important because whether you're looking at a CAPM model or a Black-Scholes model or a discounted free cash flow model, increasing that discount rate has a negative effect on valuation and price. So let me turn now to how do we handle this from an asset allocation and a portfolio design standpoint. So let me start first with valuations. What this chart shows is the price to 10 years average earnings for the S&P 500. This is Shiller-esque. It's not quite the same as the Shiller ratio, but it's very similar. And what you can see is that today, for the S&P 500, the price to 10-year average EPS is about 30 times. That's about a 3% yield. Now, Rob Arnott would tell you, from Research Affiliates, would tell you that the markets have been this rich only 3 times in the last 100 years. Once was in 1929, when it was 20% richer. Once was in 2000, when the market was 50% richer. And once was in 2007, when the valuation was just about the same as where it is today. After each of those 3 episodes, there was a market crash. Just to be clear, I'm not forecasting and not predicting a market crash. We are, however, predicting that asset valuations and asset returns over the coming 10 years will be materially lower than what we've experienced over the last 10 years. This next chart takes a look at how FuelPoint Private looks at the world from a yield standpoint. And so all of these bars represent different asset classes on an inflation-adjusted yield, using our own proprietary yield calculations. There's 3 things I would note on this chart. First, take a look at the very simple 60-40 portfolio. The inflation-adjusted yield we estimate to be about 3% going forward. Now that's materially below what any of our clients, either our institutional clients or our private clients at FuelPoint Private, are anticipating, and it's obviously well below what pension funds, endowments, and even sovereign wealth funds are assuming in some of their projections. The second thing I'd have you notice is look at U.S. core equities relative to high-yield bonds or high-yield credit. And what you'll notice is the bars are actually pretty close together. One would expect to be compensated for more risk. As you move down the capital structure from credit into equities, you would expect the yield on equities to be high enough to justify taking that additional risk. But today, they're just about equal. And that suggests to us that we're seeing mispricing and distortions created in the equity markets, and think that relative to equities, credit continues to be relatively attractive. The last point I'll make about this chart is relative to U.S. assets in Asia and other select emerging markets are materially more attractive on a forward-looking yield basis. Now, hopefully Alex is going to talk about that, and I think we'll hear some more about some of these other markets as we go in through the day. But from our vantage point, this is a very important consideration as we look forward. So rather than bother with the forecasting game, one of the ways that we think about asset allocation and design is what's the current prevailing economic regime. So on this chart, what we're showing is 4 economic regimes based on a matrix of what's happening with GDP growth and what's happening with inflation. Regime 1 is accelerating economic growth and rising inflation. And the numbers that you see in each of these boxes represent the average returns for select asset classes based on 40 years worth of data for the respective regime. Now, in an environment where economic growth is decelerating, stocks tend to underperform bonds. You can see that. But what you'll notice is across all 4 of the quadrants, no single asset class prevails all the time. Today, we think we're in regime number 1, which is the upper left-hand corner. That's a regime that's marked by accelerating growth and rising inflation. Historically, that has been an environment where commodities have actually been the best performing asset class, followed by stocks, followed by credit, and rates and the dollar have tended to be the worst performing asset class on this scale. So as we look at the FieldPoint private portfolios and the way we're constructing our client models and client portfolios, these tactical shifts are very much reflected in our current thinking. So to conclude, we have talked about what we see as the 3 major drivers of correlation shifts. So it's a combination of better economic data. We're seeing some policy pivots around what appears to be faster and accelerating inflation, but also the deglobalization move we think has been moving correlations dramatically. In addition, from a risk standpoint, we think global debt, geopolitical risk, and the handoff of monetary policy to fiscal policy are the 3 biggest risks that investors will face over the coming 5 years. These risks are accentuated by the fact that asset valuations around the globe, in our opinion, are overvalued. So as such, we think it's very important for clients, even though the economic data continues to improve, we think it's very important to accept the notion that forward returns by asset may not be as strong in the next 10 years as what we've seen in the last 10 years. So the way that we're advising our clients is twofold. First of all, the most important decision any investor can make is the price you pay for the asset. That's fully within one's control. And so we work very closely with our clients in trying to help assess where there's value throughout the market. The second piece of advice that we give is to stop allocating assets based on return predictions. We'd much rather focus on price, and rather than allocate based on returns, we suggest allocating based on risk. And we have a risk-based approach to asset allocation, which we think will help deliver much more stable and persistent portfolios through what we think will be a turbulent time ahead. So with that, I'm going to yield the floor to Alex, and thank you very much for your time.
This one's forward, right? Great. Hi, how are you? I'm Alex Ortiz. I'm the CIO of Athena International, and I'm not an economist. I am not a historian, but I am here to talk to you guys about a place that is near and dear to my heart, which is Latin America. One, for personal reasons, I was born in Bolivia, and second, my business is focused in LATAM. Basically, from our standpoint, what we want to do is be the voice about the importance of LATAM in the global markets. Global trade, as we know it, is a very important engine to the development of economic growth around the world. But that global trade has changed dramatically over the last 20 years. And I was thinking about 20 years ago, I mean, it truly was the turn of the century. But things that were happening 20 years ago are very different, and the dynamics are very different today. And I don't know if people are addressing that appropriately. And one of the things that we see going forward is that global trade is going to change dramatically as well. So it's interesting that that Bill used this map to represent how, and he used it a little bit in a different context, but from our standpoint, this is the way that the map should look like in terms of going forward. And why is that? Because we believe that countries around the Pacific Ocean are the ones that are going to lead the change, and they're going to lead the growth in that global trade that I'm talking about. In the past, in general, there's been the trade was between North and North. It was happening in the US with Europe. And as we heard Bill Kennedy talk about populism and the geopolitical risk discussed about the US and Europe. But when we look at that north-to-north global trade that was occurring over the past century, what was happening with that north-to-south trade? It was more exploitation. We believe that south-to-south trade is going to be the way forward. We believe that trade between LATAM and Asia needs to be nurtured and needs to be fostered. Of course, I mean, the U.S. plays a very, very important role in global trade. I mean, we know that the U.S. is still one of the leading importer and exporter along with China. So they're going to continue playing an important role. But we do think that Latin America needs to find its position in the global markets. There was a saying when I was growing up in Bolivia that any time that the U.S. sneezed, Latin America would catch a cold because it was so dependent on what U.S. policies were and trade. After the GFC, the Great Financial Crisis of 2008, 2009, Latin America actually withstood a lot of the pain that was happening in the U.S. and in Europe. And I think at that point, people realized in Latin America that their position was there for them to take. I want to challenge the governments in Latin America. I want to challenge the people in this room to start thinking about that. And part of the reason why this is such a great place for me and for our business and what it is that we're trying to do with voicing what Latin America can offer Asia is being in an event like this, to be able to show that Latin America has a lot to offer. The ties between what's happening in China, what's happening in other places in Asia are very important to us. Also, in the last 10 years, most people, and I'm not sure about people here in this room, but most people would think of Latin America as it being Brazil. People would say, do you have investments in Latin America? And they would say, yes, of course. And my next question was, well, is that Brazil? And they would say, yes. And most people thought that Brazil was Latin America. Until Brazil started experiencing pain, started experiencing decline in their GDP growth, and a lot of people started looking at, well, I don't want to have access, I don't want to have investments in Latin America. From our standpoint, we look at Spanish-speaking Latin America. We look at the Pacific countries on that map. And more importantly, Mexico, Colombia, Peru, and Chile. They're part of the Pacific Alliance. And those economies, yes, they're going through ups and downs, but over the last 10 years, they've had consistent growth. There's a middle class that is getting bigger and stronger. They're consuming more. The demographics in those countries are very good, young workforce. And we believe that those are the elements you need for the future and for that continued growth. So one of the things that is happening in the U.S., and I do live in the U.S., and especially with Trump taking over, and him talking about policies that can be harmful to global trade, about protectionism, Mexico has gotten the big brunt of it. And I view it as a tremendous opportunity for Mexico to take its stage in the world. It used to be that people would think of Brazil as LATAM, but actually because of what Trump has done, it has put Mexico in the map. For the right reasons or for the wrong reasons, I see Mexico in news almost on a daily basis. So people are aware of what is happening in Mexico. And I do believe that this is the time for Mexico to look elsewhere for trade, to look elsewhere for what it considers growth engines for their market. They've been very dependent on the U.S., especially since 1994 with the NAFTA agreement. And because the U.S. has had growth relatively strong, it's helped Mexico. But now, with all this protectionism talk, we do think that Mexico needs to look elsewhere. And where do they need to look? They need to look towards the West. They need to look towards Asia. They need to do more trade with China. They need to look at Asia and start forging more relationships here in Singapore, here in Japan, in Vietnam. This is a time for Mexico to become a global leader, as they should be. It also goes with the other three countries, Colombia, Peru, Chile. They've done a much better job. Their economies are different. They're more commodity-based, so they've done more trade with China over the last few years. But I do think that region of Latin America needs to look at Asia, and Asia needs to look at that region as well. For those who haven't been to Latin America, I would ask of you to go see, because really the only way to experience what is truly happening, you read a lot on the press, and most of the times there's a lot of negative things, and we all have these preconceptions about what's happening in Mexico City, how safe is it, or what's happening in Santiago or in Lima. Get on the plane. Get on a plane, go see it for yourselves. The energy that exists in those markets, those are not emerging markets. Those are what we call expanding markets. My partners and I, we constantly talk about why do we label things developed markets and emerging markets. The way that we see the world, it's expanding markets and contracting markets. And when it comes to investing, when it comes to wanting to see where the growth is going to happen, that's what we want to challenge everyone here in this room and throughout the region about which ones are those expanding markets. The term emerging Asia has been used a lot as well, and emerging Europe. from our standpoint in Latin America, we could label it as emerging America. And when we look at who is emerging America, it is those four countries. Yes, I mean, Argentina and Brazil have had their issues. They are looking to fix them, and I do think that they're going to be tremendous growth engine powerhouses in the future for LATAM. But what's important is the ties that we believe in the next 5, 10, 15, 50 years from now is going to be through the Pacific Ocean, the Pacific countries of the world. With that, I would like to have a further conversation with you and also with my panelist Bill Kennedy on that topic about how we describe the world in terms of expanding and contracting markets, and also about this topic that he raised about geopolitical risk, which, yes, in Europe, there's the call for populism, Brexit, Trump, whereas when you look at what's happened in Latin America, populism has occurred. It was there in the 80s and the 90s, so countries, and this is in general, I'm not talking about Venezuela, Brazil has just gone through one, and the same thing with Argentina, but when we look at Mexico, Colombia, Peru, and Chile, they've gone through that. They understand those, people there understand what those risks are. I've read that there's a lot of people in Europe that are looking towards Latin America to understand how do you take those risks into account when you try to decide what is risk-free and how do you invest your money. So with that said, I am done, but I'd love to have questions and have a further discussion with Bill on this.
So I'm going to take the moderator's prerogative and ask each Bill and then Alex a question, and then maybe we'll get them to ask each other a question, then we'll throw it open to the audience. So for Bill, my question is, given your background that you started in Japan and your comment that the 10-year note is a crowded trade right now. I mean, one of the most famous expressions on Wall Street when I came up started in '82, but really after the Nikkei crisis was, you got to go short the JGB, and that trade became so famous that it's called the Widowmaker, because lots and lots of money has been lost trying to bet the rise in the JGB. So what is it that's different about that trade versus the now imminent rise in U.S. interest rates? What separates those two?
I'm not sure we know yet, but if I were to draw the comparison between JGB, say around circa mid-90s, to the 10-year Treasury where we are today, I think there is a case to be made that the reaction to the financial crisis in the United States, particularly with the banking sector, which I'm a proud member of, was swift in terms of the way that non-performing loans were dealt with, in terms of the way that banks were recapitalized. All that is background to suggest that the ability to reflate post the financial crisis, 2017, is probably greater than the reflation case for JGBs, say in 1997, in that era. So that said, I don't think we're out of the woods yet. And back to the correlation issue, the biggest correlation shift that we have seen since July is that the correlation between stocks and bonds has gone from positive to negative. So from an asset allocation standpoint, that's very, very important to have bonds play the role in a portfolio they're supposed to play, which is a diversifier against the growth risk that exists in equity book, is very, very important. if we are to see the economic cycle slow down, we will have a recession someday. That's my prediction. Someday, the U.S. is going to have another recession, and when that occurs, I think you could see not just the technical buying of treasuries, but you could see interest rates stay low. I don't know if they'll test the lows that we've seen, but I think that's how I view treasuries today relative to the JGB story.
And Alex, we have a new president in the United States, and the very first thing that he did is he pulled the United States out of the TPP, the Trans-Pacific Partnership. How does that affect your view of the relationships between these west coast of Latin America countries and bilateral or under some other auspices trade agreements with Asia?
Again, this is my personal view, but I think it is a tremendous opportunity for what we've seen in the past few years, which is the continued growth in global trade that needs to occur between Asia and Latin America. I do think that the U.S. not being part of that, it is a mistake for the U.S., but it opens the door for that trade that we have been longing, which is that south-to-south trade. So are there going to be issues? Is there work to be done? Of course. But we do think that for Mexico specifically, it is a blessing in disguise. It will challenge the Mexican government to look elsewhere and not to look up north for continued growth.
Okay, before I throw it open to the audience, do either of you have a question to ask each other?
So my question of Alex, and just to set the table, we are tactically overweight Mexican equities right now, which we've been since late fourth quarter of last year. So that's where the question's coming from. Do you think a renegotiation of NAFTA is better for Mexico or worse for the United States? What's the relative play between the two?
There's probably people in this room that could answer that much better than I would, but I'll give you my, again, my personal opinion on that. And I think when NAFTA was agreed upon was back in 1994. The world was very different back then. Is there a need to look at it and see what has worked, what hasn't worked? I think it's important. I do believe that, again, the rhetoric from our president is more because of what he said during his campaign trail, that there's going to be a wall built and we're going to renegotiate NAFTA, and NAFTA is bad. And but I do think when everybody sits down at the table, they look at it, they tweak certain things here and there. The biggest cost, if it goes through and there's the renegotiations that we've heard in the press, I do think it's going to be worse for the U.S. I think inflation is going to come much harder, much quicker, and much stronger than anybody expects. So that is where I do think the U.S. would be wise not to poke too much into that agreement. My question to you, which I was referring back on the podium, is this populism that you spoke about in Europe and in the U.S. and how to assess that risk in the labeling of DM, EM. Do you think that geopolitical risk is going to affect the asset class? Is it going to be, will the labeling change in the world about how equities and fixed income get looked at by asset allocators?
Generically, yes. And what I mean by that is we've gone through the era of BRICS. All right, I think BRICS as a terminology, it doesn't really apply that much anymore. So as we continue, I kind of like the way you've talked about it. There are economies that are expanding and there are economies that are contracting, and maybe that's really the way to think about it. It would go back to the 4-square framework that we use for asset allocation. Which regime are you in? You can use that same idea of regime 1 or regime 4 or regime 3 by country and make asset allocation decisions based on what the inflation and the growth dynamic might look like. I think for certain countries, you'd want to take in the current account surplus or current account deficit, where the currency is, how much excess reserves they have, and the like. But if the developed markets are as overvalued as we think they are, I don't think labels matter as much. It's where's the return of capital and the return on capital, and then geographically, if that happens to be in Asia or Latin America or elsewhere, we're happy to take advantage of it.
All right, we'd like to...
Can I make one point? Sure. The other thing that we've seen, and just going back to this concept of expanding and contracting economies or countries, is regional investment. When we look at developed markets, there seems to be the U.S., there seems to be Europe, and there seems to be Japan, and those are those buckets in DM. And then when we look at emerging markets, they just get all thrown into one big basket. And why is that? I think that part of it is liquidity, because you back in the 90s, you didn't have much liquidity in the mid cap and the small cap, so it was easier to just put everything and call it an emerging market. As we progress, we do believe in regional investment. Latin America is very different than Asia. There's a lot of commonality in the demographics and the growth potential, the internal consumption, but very different dynamics that occur. And we do think that local experts, local players in those markets are the ones that are best suited at providing that regional emerging market exposure. We've talked to a lot of asset allocators who look at global EM, and I asked them about Latin America, and they say, yeah, we got a little bit of Brazil, we got the top company in Mexico, the top company in Colombia, but then that's it. The growth that's happening in Latin America is really in the small to mid cap, and yes, the liquidity doesn't exist as much as the large cap, but that's where the growth is going to happen. So you need to allow the local expert to provide that expertise. I always think of traveling. When you travel, and it was my first time here in Singapore, would I feel more confident if I had a local guy showing me where to go eat? Or if I heard it from somebody that said, oh, go to this place? I would feel more comfortable, somebody that I can trust that takes me to a place to go eat. It's just, that's how we think investing should be looked at as well.
All right, if you could identify yourself so that we know who to blame and attack out in the hall later on.
Okay, yeah, absolutely. I'm John Doyle from UOB Asset Management, and I wanted to pick up on a comment that Bill made about the greatest risk being debt out there. And most would associate that with the developed market problem. I think Japan, obviously, the furthest out in the curve, which you would very well know. And then demographics also a factor. But I would point to the fact that it's again, this BRICS notion that all of the EM are on the same stages is very, very different. Some of them have been accumulating debt at very different paces and have very different demographics. So that's the first issue. And then the second issue I'd like you to comment on maybe is this notion about populism, that it is right now being associated as more of a developed market risk. but I would point to countries like South Korea, which is kind of an emerging, or almost, you could call it an advanced economy, but it's still classified as an emerging market, that they have similar characteristics, stagnant wages, high Gini coefficients, second highest to the U.S. in the world, and there's this potential swing that could happen there, and that's an economy with a fair bit of domestic debt as well. So, the fact that I would agree that there's very promising prospects in some of the EM, the under-leveraged emerging markets, with a lot of headroom, so to speak, in terms of leveraging up and growing productivity. But there's other EMs that are significant risks that I see. So curious your thinking on those issues, and I'll leave it to both of you gentlemen to answer, please.
So the tie-in that I make between populism and protectionism, or the talk of protectionism, keep in mind, in the U.S. it's just talk thus far. It's a lot of talk. It's a lot of protectionist talk, but nothing's truly been implemented yet. It's politically convenient to blame that chart that I showed of declining GDP or disposable income per capita. It's politically convenient to blame that on outside forces, on other countries, not our problem. So, part of the way we're thinking of it is not trying to parse where is the talk of protectionism, simply that, it's talk, and where do we actually see it happening? And what's the magnitude of effect on the underlying economy? And Korea is a great example, because the geopolitical turmoil that could exist there for a country that's so heavily dependent on exports, and I think becomes a real issue. So again, I think you made the statement, you can't paint every emerging market with the same brush. Completely agree with that statement. I mean, the environment we're in today is very country specific, and so taking into account current account situation, excess reserves, how indebted are they? Is that debt sticky or hot money? All those issues come into play.
I do think, again, like you said, South Korea, EM, it's because of what it's undergoing politically. It's probably, in my view, a place that you might look to underweight until some of this, the political risk subsides. But again, I would leave it to a local expert to tell me that. When I can talk more about what's in Latin America, in Brazil specifically. I lived in Brazil for 6 years, and in the 70s and in the 80s, and when Lula da Silva won the presidency, I thought Brazil was done. That was it. I mean, he was a populist. He was going to come in and he was going to destroy the country. But actually what he did, and again, it goes back to a little bit of what we heard earlier about luck. Brazil was lucky with the commodities boom, and Lula was really the right person at the right time in Brazil. What should have happened, in my book, is that a business-friendly president should have taken over and not continued populism in Brazil, where now Brazil is in disarray. They're going to change. It's not a place again, in my opinion, not a place to be investing until that clears up. So it's populism, geopolitical risk. It's an important element, interesting element. Again, best left for the experts to help us guide on those decisions.
We have time for one more question. Over here, Jill. Mario?
You can answer.
Good morning. My name is Mario Artaza. I work for Banco Security in Hong Kong. I'd like to ask the panelists with regards to an issue that was raised in the initial conference, which was the management of expectations. And it would seem that one element that is flowering up all over the world is that societies have tremendous expectations on who governs them. A, and B, tremendous expectations that everyone can be rich, or everyone can have a lot of money. And reality is different. So how do you foresee the management of expectations in the world that we're living today with this populism that we'll be talking about immediately after you, in terms of breaking down barriers for markets to be more integrated, in terms of expectations with regards to how you invest your capital in different countries? It's kind of ironic today that the high expectations that we have for our returns are in a country that is ruled by 88 million people, in a country that has values in political governance which is different than for where we grew up or where we pledged allegiance to. So if we could have your thoughts about that, please. Thank you.
I'll go first on that. I think that topic itself, we could spend a whole day on managing expectations. I think the role of governments, and this is across the board, doesn't matter where it is to guide, but not to provide for people. I think the government's role is to give opportunities for people to work, give opportunities for people to have access to the services that a lot of us are used to, and I do think that managing expectation should be more from the standpoint of governments talking about that. The problem is that most people, in general, they like to hear the rhetoric of "my life is going to be better if this person gets elected," because that's how people think. They goes back to, well, it's not me. It's not. They don't take ownership of their problems. It's somebody else's problem. And if that one person that talks about making something great again, that's good. I'll vote for them, because maybe I'll just sit here and wait for it to happen. So that managing expectation, I do think that there's been, in the political arena, a lot of lies, and people just tend to throw their support to that. And then when it doesn't happen, you have a change of government. The U.S. I don't think there's been a time where a party has held power more than 12 years, except when I think FDR was president. And why is that? Because it's after 12 years, you're like, okay, well, I need something different. Doesn't matter what it is, but I just need something different, because maybe that something different will make me, get me more things that I want.
I would answer the expectation question three ways. First, capital market expectations are way off the mark. In the last 5 years, you've had the S&P 500 deliver 14% return and about 12% volatility. That's a Sharpe ratio higher than 1. I have to keep telling all my analysts that work for me joined the industry after 2008, and they think a Sharpe ratio for the S&P 500 greater than 1 is normal. No, it's not. It's about half of that. It's less than half of that. So I think the expectation of lower returns and higher volatility have to be built into the capital market expectations for investors. The second way, I like to think of myself as a globalist, but I'm a liar, because if you look at the way we benchmark our clients and equities, we benchmark them against global MSCI World Index. But we actually manage their money about 70% U.S. equities, 30% non-U.S. equities. That has to change. We do that because they're comfortable with that, but if we truly want to give them the best opportunity and do our fiduciary duty, we have to expand their international exposure, both in equities and fixed income. The last thing about expectations, I have no idea politically and from a government standpoint how it will unfold, but I'm pretty certain it will include more debt before we see less debt. So I think the 350% debt to GDP on a global scale is likely to get bigger before it gets smaller.
Thank you very much. Thank our panelists, Bill and Alex. And now I'm going to invite Diego and Don Rissmiller up, and I'm going to sit right here because I'm on this panel too.
Thank you. Pleasure. Thank you.